Hey, what's up, 0 to 100 family? This is Gabriel Hamill, and we are on site this week at a 0 to 100 live event. So we have decided to create a special highlight reel episode for you. We've decided to pull 5 of our best tactical segments from the past year. Each of the investors that we interview break down a different strategy from small multifamily to ground up development and more. Let's start with Mr. Justin Cambra, who built enough cash flow to quit his job at Amazon. We're going to focus specifically on some of the hidden cash flow that Justin found at his first property in a parking lot. That's right, a parking lot. All right, here's Justin Cambra on the 0 to 100 podcast show.
I used to live downtown for like, I don't know, 2,500. Then I bought this property, ended up renting the lower unit for like $2,000. I think I paid less than $1,000, so I was lowering my monthly cost. But then I had like this large paved lot. And so I'm sure we'll get into this, but I'm renting that parking lot out for parking lot income. But my end game is I tear the duplex down. I can build 8 houses there today. And if I upzone it to my neighbor's zoning, I can do 12 houses.
Wait, so you're renting a parking lot to who?
Yeah. So imagine Airbnb for a parking lot. So it's called Neighbor. And there's a couple other companies out there that do this, but I heard through a friend of mine who also used to work at Amazon about this program called Neighbor. He said he's renting out his garage on Neighbor and he's getting like $150 a month in Detroit. You know, I was in Detroit for a conference and I was like, I met him at Starbucks. From that Starbucks to the airport and Uber ride, I created a listing, put it online, and less than a month later, I had my first booking. And, you know, I started at $150 a month and my peak month was like $3,400.
And that's just all vehicle parking.
Exactly.
It's not even striped out or anything. It's just a big empty field and people pull up and park there.
It's a paved. So the reason why my parking lot's paved is where I live at. You know, if you go back to like 20 years, the guy that owned that house built 3 4-plexes next door and he paved behind the house for parking for the 12-plex. Well, then the next guy bought it and he split the 2 lots into half, right? And then I bought the duplex with all the parking away from that. So I inherently had this asset that I didn't capitalize on for literally like 6 years.
But you knew it was an area, big lot. It was that and one for you. The house worked on its own without that, but you knew there was some upside at some point with that lot.
We say this all the time. Like we tell people, look in your existing portfolio because a lot of times there's gold that you don't even see. And man, like I've never even thought of that. I'm already thinking like, man, I wonder what I can rent. Can I rent my front yard out? Like, I think that's great. Like, how can you maximize all the tools in your toolkit to generate as much cash flow as you can?
I thought the same thing. You mentioned Neighbor like last October. I totally forgot about it, and I'm thinking right now. I was like, I have a flat 1 acre lot at one of my next door to one of my mobile home parks, and it's just sitting there vacant.
We have 10 acres in Wisconsin. That's So yeah, we need to work on that.
That was an awesome story. Super resourceful, and no wonder Justin was able to build a big portfolio with that mindset. Up next, my guy, Mr. Grant Francke. If you want to build a portfolio of small multifamily, this is your guy. This episode is for you.
Grant, what does your portfolio look like today?
Yeah, so we're just over 120 units, all in the Lincoln, Nebraska area. So southeast Nebraska. We've got a few small college towns around there that we invest in as well, but it's all small multifamily, those single families, duplexes, 4, 6, up to a couple 10-plexes as well.
So walk us through, I mean, we got to you did that first duplex and you did the 5 seller finance deals. Then you're using the line of credit off the 2 free and clear homes to go buy more real estate. Talk about how you scaled then from those 6 properties to 120 units, because that's really our audience. I mean, that's the name of this podcast, 0 to 100. You've done it. I think for a lot of people, yes, that first deal is challenging, but then it's that mindset of like, all right, how do I go from 1 to 10? How do I go from 10 to 100 plus? So I'm curious, you have those 6 properties and then what?
Yeah. So I started doing some direct mail, and it's not direct mail like everybody talks about where you send out 20,000 letters and see what sticks. It's very targeted to certain owners that certain properties that I like. I was targeting owners that had large portfolios that would maybe want to sell off one or two. I wouldn't target somebody who just had one duplex because then they would have to sell their entire portfolio to me, which might be scary for them. So I was targeting some of those people. I got a hold of one owner that we bought 3 sixplexes from him. And it was just like my other deal. Like I showed up, I closed on time. Great transaction. I still talk to him to this day. We've golfed together a few times. So we were able to scale it that way. But then because we showed up and we did things right, he actually referred 2 more sellers to me. And we bought another 20 some units just from that one letter that we sent out. That one good transaction we had, that one good relationship led us to, over 38 units.
Wow, that's amazing. Were those also seller finance deals?
No, those are traditional. Well, not traditional. We just did commercial debt on those.
Grant, when you talk about the lettering, I love that how you're like, no, it's very specific to these specific owners. What did that letter look like? I know you don't have to say the exact script, but like you found this owner where, and you knew they had this portfolio. How was that? And then what did that letter look like?
Yeah, so I spend probably too much time on county assessor sites, just snooping around at who owns what. So I was doing that for this area that we wanted to go to. And my letter is very disarming. It's just like, hey, I'm an investor. I'm not a broker, not an agent. I'm just looking to scale my portfolio. If you ever want to talk about it, just let me know. This is my number, my email. And then I put a picture of my family on there. I feel like that's kind of disarming. Like, it's like, I'm just like you. I'm just an average person that just wants to scale my portfolio, which we've had fairly good luck with that. I mean, I'm not like, we haven't had 50% hit rate or anything, but the deals we've gotten from those have been very fruitful.
It's probably handwritten as well, I'm guessing.
Yeah, handwritten. And then I sign it and hand address the envelope, all that stuff.
Grant, what you just said you wrote is very similar to the verbiage I used when I used to call these potential sellers on Craigslist. I would say, hey, I'm local to the area. I'm not a broker. I'm not an agent, right? That alone, because a lot of investors get phone calls and letters from agents and brokers wanting to list their property. And so what you said reminded me exactly almost to what I would say. I said, hey, I'm local guy, live in the area. I'm not an agent. I'm not a broker. And that actually allowed a pretty decent conversation because it does disarm that, like, hey, I don't want to list my property with you.
Yeah.
And it becomes a little more face-to-face, human-to-human versus transactional.
Yeah. And one thing I do include there too is like, if I have a area that I have like a fourplex in, I'll be like, hey, I own this building at 146 Wedgwood, right down the road. This is me. You see how I take care of my property. I'm a real person. I'd love to purchase your property if we could.
Well, I think people forget that business is a people sport, right? And you mentioned it earlier. You sent one letter out, and out of that, you got a great deal because you are a good person. I like you said that. Be a good person. Mitch and I argue about that quite a bit because he struggles in that area. But no, I'm joking. But like, be a good person. Do what you say you're going to do. Right. Have integrity, and then also like in a transaction. I say this a lot. If you approach a transaction through the lens that everybody has to win, right? I win, the bank wins, the seller wins, the tenants win. If you have investors, they win. Then it's a very frictionless business, and it feels really good. And you did that. You showed up, you did what you said, and then he introduced you to other sellers, which is crazy. Like, you must be a great relationship guy, man, because a lot of people see this as and I hate the word transaction. Like, we need a transaction coordinator because it's not a transaction. It's teamwork. And so, like, what do you do anything to really foster those relationships and build those? Or are you just like your genuine self?
I can't say I do anything like outside of just being a decent human being. Like, I try to end every transaction with the intent that I would do another transaction with that person, or they would refer me to somebody else. That's happened to all of them, but like one transaction wasn't smooth. But I try to end every transaction that I want the person to feel good about it. I want me to feel good about it. So we're not taking advantage of each other. It's going to be a win-win, and just help everybody out.
All right, you just got done hearing Grant Francke. Next up, you're going to hear Ben Kall. This is our most popular episode, and this question will lead Ben into talking about his first few self-storage deals. Let's roll the tape.
Ben, I want to go back to that 1 a.m. snowplow moment. I mean, when I was managing my own properties and it was 10 o'clock at night and I'm trying to fix a toilet and my knuckles are bleeding and I'm I'm not that handy. I'm just like, what am I doing? But I'm curious, it's 1 a.m., it's cold, it's windy, you're plowing the snow and you realize, hey, I need to get on the other side of this equation. I need to get on the investor side. I need some passive. I want to be the guy sleeping where the money comes in. So I understand the mindset shift there. What was the next action you took once you realized, hey, I want to be on the other side of this equation?
So the immediate action, I was making all this stuff up as I went. My goal when I joined the Remax brokers as an agent when I got started is because Remax had the dominant heavy hitters in my town. And I just knew if I was in the same building as them, I could watch what they do and just copy it. And as I started reading books, real estate's been around for a long time. It's really rare you reinvent anything. You just steal bits and pieces that are comforting and will allow you to get started. And so that was really all it was, is just what can get me started, what can get me in the door, and how can I read? And really this was back in 2016. So it's kind of like the beginning of the podcast era. And there wasn't a lot of resources out there at the time, but that was when Bigger Pockets was big, and I would listen to everything mowing lawns, and I would just like jot notes, and they'd have like little script or kind of role play conversations. And I would just like stop the mower and voice text to myself. And then I just like copy and paste and send text messages to basically my clients that I knew were investors. And I just said, I want to grow my investment business. I would love to continue to work for you and learn from you. Let me know if there's anything I can do to be a better operator for you. So really simple. And now looking back on that, I wasn't plugging, I want to own my own stuff. It was, I want to help you grow and I want to continue to learn. And now if you fast forward to my first investment, it was a self-storage facility. And my business partner was the guy that I kind of had as a mentor and was on my pedestal because he was the largest owner of multifamily that I managed for. And, funny enough, it was a commercial lender that he had worked with directly and I passed referrals to as a broker. And this guy said, hey, this is bigger than you or Adam would ever typically do. You guys should talk. We have the loan. It's not on the market yet. We think you guys should buy it. And it was as simple as that. And so Adam and I, he was my client at the time, and I managed his multifamily. We basically sat down and he looked at me and he said, Ben, this is way bigger and I couldn't do it without an operator. You've made me a lot of money over the years doing my multifamily. How much money do you got? Because I want you to be my partner. And it was the simplest partnership discussion in the world. It was, how much money do we each have? That's our ownership percentage. Move forward. That was it.
Ben, will you talk through that? Like, what's the size of the property? If you remember the down payment purchase price, kind of some rough terms.
Yeah. So the deal, we went under contract for $1.5 million. The down payment, I believe, was, I know mine, it was $72,000 was my commitment to the deal. And that's basically, we saved up absolutely everything, for that. My wife and I just knew how much we respected Adam, and that, how conservative was. I knew what his numbers looked like because I was in charge of them. And so if Adam was ready to move forward, we're just like, yep, we trust him. And we went for it. Like, I didn't know how to underwrite at the time. I just completely relied on Adam's underwriting and his ability to pick good investments. And so it was $1.5 million self-storage facility where I put in $72,000.
You still own that property there?
Yeah, which that got me 20% ownership in the partnership.
Did you say what was the size of that?
1.5 million.
No, what was how many units?
To just shy of 250.
You had mentioned that, or was it a multifamily?
Self-storage.
Oh, self-storage. I'm like, geez, that's a really big. Pay attention, Travis. Come on. Hi, welcome to the podcast. Okay. Well, I wanted to go back a second. Because we talk about this stuff all the time with our elite members, which is the 0-100 Mastermind on this podcast. There's a formula that we talk about, and I promise you it works. We talk about, tell people what you're up to, right? Get out there, tell everybody what you want to do. Get out there, be passionate about what you want to do. Also, like, add value. Meet somebody that you respect. Ask how you can add value, because the universe works in amazing ways. You add value, you tell people what you're up to, opportunities come your way. And this is exactly what you did. And it's exactly what opportunity came your way. Was this deal, you mentioned a lender called you and told you about this deal? Was it, was the deal, was it distressed? Is that why the lender knew about it, or?
Effectively what it was, the husband built up these businesses over the years. He had passed away tragically, and his wife was a widow left in charge of running the like Napa Auto Parts business, the self-storage. And so she slowly would sell things off over the years, and this was the last asset that she had. And now looking back on it, I mean, this is like the complete unicorn. No website. She would handwrite invoices to all 250 tenants. She'd go to Florida for the winter. Her answering machine would say, sorry, I'm gone for the winter. Call me back in April. Like complete unicorn in the storage world, right? Now knowing what I know. But that's what we were dealing with at the time.
But this doesn't surprise me at all because, we talk to a lot of investors. We're obviously investors ourselves. There's so many similar stories where, I say all the time, I can trace every single deal back to a conversation and or a relationship. And this is such a great example of your relationship with your mentor investor friend. You were managing properties for them, your lender relationship. Yeah, some may call it you called it a unicorn, but it's like you were in the right position and you were actually ready to also take action when that opportunity came. And a lot of that, when I hear that story, is because of the relationship and trust that you have built within your circle.
On that note, fast forward to like today, our entire business model is built around relationships and delayed gratification. And so now going back to that moment in time, I didn't know what I was doing when I started my management company. I didn't know what to charge and what standard practice was and how management companies typically bake on fee after fee after fee. I just started a flat rate at 8%, and all of the handyman work I did for $36 because that was my college football number. Like that's how simple things were at the beginning.
So awesome.
And so I get why everyone made so much money and like why, I was just kind of getting by at the beginning. But the thing that I learned is I added so much value to them. They respected me more and more. They understood that I was an operator. They understood that I would do whatever it would take to ensure that their properties were staying full. We were on top of maintenance things, and I don't know if they knew that that's how I was actually like living my life based off of those fees and why I offered to do all those things, but I provided the amount of value that you fast forward now today again, every single owner that I still have in my third party management portfolio is now an LP in all of my LIG deals that we do today. So back at the time, the goal was to sell them a house, manage it, do well, sell them another house, get a commission check, get a bigger management fee. Now they've realized there's still a lot there for them personally guaranteeing those properties. Now I'm on the hook for all the personal guarantees. I literally do everything and they just get checks quarterly. So it's been a really interesting pipeline to watch evolve over these phases along my journey.
Well, you led with value. You led with value and doing the right thing. And now you have this network of people that know you, like you, and trust you and want to do business with you. I think it's like we say these things often. I think it's so hard to teach because it's almost like the human element that sometimes people miss. People want to automate investing in real estate so much. This is just such an example of like,
yeah, we talk about it all the time. Like, do you see the long game? Maybe you didn't know it at the time. Maybe you're just like, I'm charging 8%. But at the end of the day, you're providing value and you're trying to build relationships that add long-term value. And that's how you build wealth. Wealth isn't just in the form of money and finances. It's also in the form of connections and relationship and knowledge. And you're cashing it away early.
So Ben, what's the next deal? You buy this deal,
which is a huge deal, by the way, for your first deal.
It's awesome. Was it a big aha where you're like, oh, I've got some cash flow and I've got some equity, and like, did you get addicted to the idea of acquiring at that point, or what happened next?
Both myself and Adam, my partner, he put up 80% of the money, which was a huge stretch for him at the time. And it was even bigger to us because it was literally our life savings again, going into something that's brand new. And so to be honest, we were scared shitless. We had no idea what we got into. And just basically the same concept that we talked before, one of those, huge pivots and mentality shifts. That's like, okay, we're in this thing. We got to figure it out. And so as I alluded to, there was no AJ Osborne self-storage podcast back then, right? And so I literally just drove around when I wasn't answering the phone, and I stopped at every single storage facility I could get to and be like, hey, I just bought the storage facility. What do I do? And I would try just asking people that were willing to tell me what to do. And it was really, really hard because no one wanted to share their trade secrets. And so the closest thing that I had was a couple of buddies that owned hotels. And I said, hey, here's what I'm doing. Like, what do you do at your hotel? Right. And so now I know what they taught me was dynamic pricing, get a website, rent online, hands off. So they implemented all those things for me because of how hotel operators operated. And I just said, well, that seems good. Like, I hate driving 20 minutes one way to give someone a key for a $45 rental and then drive 20 minutes back home and do that 3 times a day. Like, it's just not efficient. So, being clueless, basically, I adopted a hotel model. And now that's turns out, fast forward 8 years, I mean, that's standard practice today.
You see it through different eyes than somebody who's been in the industry for 20 years or 30 years or whatever. You can see like innovation. So I live my life clueless, man. I think it's interesting how you're like, I was scared shitless because I started laughing because I'm like, I feel the first mobile home park we bought, I called Travis the next morning. I'm like, how you doing? He's like, I just threw up a little bit.
And I think, on that though, the thing that I still talk about today when I talk about my journey and there's, younger people calling me looking for advice, one of the biggest things that I take from an athlete is all of the training that goes into being a competitive athlete. And I remember my freshman year in college football, our strength coach would just be screaming. And he's like, you need to learn how to be comfortable being uncomfortable. And that's something that's always stuck with me. So I think, as you talk about mindset shifts, as you talk about becoming an entrepreneur and eventually scaling, every different stage as you climb the ladder, climb to the mountain peak, you're always continuing to be uncomfortable. And if you're not uncomfortable, you're probably getting complacent. You're not going to grow anymore.
All right, so we've covered parking lots, small multifamily, and self-storage. Let's move on to some more advanced strategies involving raising capital. Next up is Dustin Baldwin talking about ground-up development in Florida and what we call the BRRR strategy. All right, you'll get that reference in a minute.
And then from single-family houses, it transitioned into looking for zoning codes that allowed for more than one unit per parcel. And I would buy a house on it or buy a piece of vacant dirt, and I would put a set of townhouses on it. And the very first one I did, for example, I was all in on the project for $850,000. It was 2 duplexes, 2 3-bedroom, 3 baths, 2,100 square feet each. It ended up appraising each side for $850,000.
Oh my gosh!
Wow. How'd you finance that property?
That's exactly what I was going to ask. Yeah.
So that property, great question, because it was my first one where it was custom and I was the developer. I decided to do it all cash because I didn't want the holding costs of it taking a little longer. I understand that a lot of people don't have that luxury, but we had the exit from the company, so I just decided to use my own money. Now that I've learned it and I've made my own mistakes with hiring not good architects, ripping up trusses, all that, now to scale, I bring on investor capital, and then we also use bank debt. So we have a capital stack, but the first one I did was all cash.
Yeah. Dustin, I have a question. You bring up scale. That's a big part of 0 to 100. We talk about scale. I mean, in a lot of ways, 0 to 100 started because Travis and Mitch were curious. Why is it that some people take 20 years and they own a duplex and other people scale to hundreds and sometimes thousands of units in a short period of time? Some people are looking to scale because they love the game. Sometimes it's cash flow. Sometimes it's building equity, building net worth. What was your motivation to scale? You did a couple of these deals, and then you said you asked yourself, like, how do I scale this? I'm curious your mindset around why you wanted to scale. What was the desired outcome to go bigger and do more?
Yeah, that's a great question. So here in St. Petersburg, I think that there's a unique opportunity as there is in some other cities in the U.S., but I believe it's extremely undervalued for what we have here. And I wanted to be able to own as much real estate, new construction here in Pinellas County, in St. Petersburg, Florida, as I possibly could over the next 10 years, because I think when the secret comes out, it's just going to be explosive growth. And I want to ride that appreciation train while, in the meantime, also earning cash flow off of all of those projects.
That's awesome. I love this strategy. It's interesting because I meet developers who develop and sell, right? And then I meet a lot of buy and holds. But the way that you just lay that out was like, no, I develop, refi, and then hold for cash flow. And it feels like if I'm hearing you right, like you're really creating your value on the build. You find the right land, you build the right thing. You got a lot of value to unlock there. You refi, maybe you're pulling out all your money or all your money plus some or whatever. That depends on the deal. But then your mindset is, look, I'm going to hold in cash flow throughout time. Am I hearing you right? Is that sort of your strategy today as well?
Yeah, it is. I will say that interest rates have made it a little tricky, where we did have to turn one of them into a build to sell because it just did not make sense.
Got it.
There's
always a one-offs. Yeah.
So it's not the
that's
BRRR,
interesting.
it's the BRRR. It's the instead the buy bill.
Travis has been working on this the entire time, by the way.
Down your resume. We got
Buy, build, rent, refinance, repeat. Yep.
Do you create so much value in these deals because you're building, right? And I do, like, that's a great way, and you're smart. That's a great way to build a lot of value and equity. Do you generally get all your initial capital back out? And so you're no cash in and you're just holding it for cash flow?
Yeah. On the last three deals I did, the ones that we're looking at in the future, we're projecting them super conservatively, and we're projecting having to leave $50,000 to $100,000 in just so that they continue the cash flow. And we don't want it to be too tight, because that's how you get yourself in trouble when you over leverage. So, but then the cash on the money you're leaving in is like 15 to 18%. So like, I don't care. I'll leave the cash in.
What were the last three deals? Were they, what property size? What did those look like?
Yep. So last three were the set of townhouses that I just talked about. It was a triplex that we're wrapping up right now. I'm getting rented up. And then the other one, we actually ended up having to sell that one. It was a single family house, but we're also now doing a set of townhouses, and we found a zoning code that allows us give each townhouse an accessory dwelling unit behind it. The 4 units total
nice.
on a 5,000 square foot lot. So now it's a townhouse with a rentable unit in the back. And I'm building, there's a big shortage here in St. Petersburg with larger rentals. So like between 3 and 4 bedrooms, new construction rent really well here. And I'm getting great rents for them. And then on top of that, the 1-1s rent really well. So now you have both. You have 2 sets of each on one lot. So it's going to enable us to be able to most likely pull out all of the capital, and we're done.
It seems like a lot of areas are sort of loosening up their guidelines on ADUs or DADUs or whatever you call it.
Huge
right?
opportunity.
Like they're they're finding that like there's so much untapped land, and if they can sort of regulate it, it's built under code. Do you see that? It sounds like, are they loosening up guidelines where you are in St. Petersburg as well? Is it easier to do?
I wouldn't say they're loosening them up. They've created an open mind around one zoning code that was previously just for single family. They allowed you to now do up to 4 units on there. However, there's very strict guidelines you have to meet. And that's what they did because they didn't want, the neighbors were not happy about this change. So in order to help the neighborhoods and to help the general public swallow this pill that we do need more housing in St. Pete, there was very strict parameters as far as the design, the FAR, which is the floor area ratio, and how much you can build on these lots. You can't just build an 85-foot structure of 4 units. Like
you can't have guys like Mitch come along and put a 30-unit mobile home park on a 5,000 square foot lot.
I just stack them like a 3-plex, three mobile homes.
I do agree,
Sounds
though.
phenomenal.
I think we've had a few people on the show that are doing a lot in ADUs, and I feel like there's just a lot of untapped potential because so many of these markets, everybody's screaming for infill, getting more density in the amount of land that you have. It's going to create more supply, which is going to hopefully bring the cost of housing down. And you've got these massive lots in a lot of these cities where you have one house on it. So I think, as long as you're adhering to certain codes and it's not just like a Frankenstein monster, I think it's a great solution. And I think everybody wins. The renter wins, the investor or developer wins, and just the general housing market wins with more affordable housing. So I love that, man. I think there's some really cool opportunities there.
Dustin, I'm curious what advice you have for those that want to develop. I think I've met a lot of people that have lost their shit in development. I own a lot of real estate that has great zoning, but I've never even had a single family home build. I've never done any kind of new construction. And when I run the numbers, it's hard for me to make sense of it. Right. And so I'm curious to what advice you have, but also what have you done to really mitigate that risk when you are developing and building something new?
Yeah, for sure. If someone's getting started and has never done it before, first thing I would say is like find a great builder that's willing to also consult with you on the development side, the design and the planning side of it, and then help you figure out highest and best use, because it's likely you're not going to know the code to do that. Like a consultant is key. Unless you have the time to dig into the city muni code to learn it inside and out, and you have the money to take the risk to do it yourself, then do it yourself. That's what I did. But you're going to save yourself a lot of time and money by getting somebody that knows what they're doing. And I would say location is everything. If you're building new construction and a nice area and you can get the land for a reasonable price, it's really easy
I wouldn't say easy. It's easier to make the numbers work. Where I struggle to make the numbers work are areas that are, the land's super cheap, but nobody's going to want to rent there because it's not walkable to anything. You can't jump on the bus to go to the beach. So the location is the first thing I look for. And then I try to look at highest and best use. And if I can put multiple units there, it helps spread out the cost of construction, but also brings my rents up. So it helps to do it. And I won't, honestly, I'm pretty picky with what I build. I know there's guys out there that build with like very small margin. I want huge margins on my deals because if anything goes wrong or the market downturns, I still want to make a profit. Even though it might not be a huge profit, at least that's protected from like a downturn. So I pass on a lot of deals that look okay or look good for some people. Like I look for great deals and I'm willing to wait for them. So I'd say that that's also a huge importance when you're looking for your first development.
Hard not to love Dustin's strategy. Super smart. And last but not least, our buddy, Mr. Pasha Esfandiary on scaling a mobile home park empire. Pay attention.
You amassed a pretty solid real estate portfolio in a short period of time. So you're playing real life Monopoly too.
Yes.
1,850 plus units in the 24-month period.
It's a lot of greenhouses.
Let's talk about that. Because as we talk a lot about scale, and I think scale for a lot of people is challenging. Sometimes it's a mindset thing. People can't get past the idea of owning something bigger than a duplex or maybe a fourplex. Other people realize that scale is the way to become financially free through real estate, and there's obviously different ways to scale. So I'd love to hear your real life Monopoly story of how you were able to scale your portfolio to achieve financial freedom through cash flow real estate.
Sure. So I will say that we are a little bit above that 1,800 number now. We're at 2,150. What I will say is this, and it's funny because we haven't really bought much real estate in the last 10 months just because interest rates were so high. The way I view life and everything that comes at me, because sometimes scale can be irresponsible, in my opinion, when you're just scaling too fast and you're just buying properties to buy properties. And anyone who's really been in real estate knows that some people just buy real estate to be like, oh, look, I bought this real estate. It's not the way to go about it. What really unlocked my scalability is that I partnered with two incredible partners who know everything and anything about mobile home parks. And we also had a grand vision. And so we were just buying parks ourselves. When it got to the point where we essentially ran out of money, we found a deal that met all of our numbers and our criteria in a major way. So then it's just obvious, well, we don't want to pass up on this deal. What are we going to do? Let's figure out how to syndicate our first deal. Great. As soon as we syndicated our first deal, another deal came our way because now we're increasing the pipeline and things are growing. It just happened organically.
Pasha, how many parks did you buy with your partners prior to syndicated?
It was close to 5 or 6.
Okay.
And we bought a few apartment complexes before that as well, too.
And how'd you find those partners? We talk a lot about building your network, organic network, meeting people, building relationships. How'd you find those partners?
Yeah, I actually, because I've had a bad partnership in my development deals, I was very much thinking about I'm going to go alone at this. I hired my two partners to overlook my shoulders on my first apartment deals. And these guys crushed it and knocked out of the park and went over and beyond on a level of standard that I had and even more, where I said, these are the kind of guys I want to align myself with. And because of that, cut them into some of the deals. And then when they presented mobile home park deals to me saying, hey, we should buy this. And we just slowly grew organically that way. We had a trial run with each other.
So you bought 5 or 6 parks with these couple partners. Were those JV'd or how were those structured? JV.
Yeah.
And then you decided, okay, we've spent all our money or a majority of our money on parks.
Yeah.
But we want to keep scaling.
That's where you got to be though, right? Get rid of the cash.
Yeah. And so now you decided to syndicate after 5 or 6 parks in. What did that look like?
Yeah. So it's funny because I was telling my partners back then, this was a little over 2 years ago. I was like, I've never really asked for money. I've always been a lone wolf. This is like a $750K raise. I don't know who to ask. And we were able to raise it within the first 8 calls. I was like, holy shit, this is pretty cool. And then the next one was a little bit more. And the next one was a little bit more. And we did 4 syndication deals. And then deals kept coming our way. And so I was like, guys, the only obvious thing to do after now, let's just create a fund. And so, and you learn, right? So the way I look at things is that I have a long-term goal and I have a vision that's so vivid that I'm going to make myself grow into that person. And so when I see the opportunities, I'm just going to keep growing. And that's what we did. I'm in the camp that if you find a good deal, you got to buy it. You got to figure it out. You got to buy it. Good deals don't come to you all the time. And so in that time, there was great deals all over the place. Money was super cheap. Not many people knew what the hell they were doing in mobile home parks, and not many competitors on the scale that we were doing it at.
Pasha, what's your criteria for a good deal on a mobile home park? I'm genuinely curious to see if it aligns, because we're all mobile home park investors. I don't know if you knew that. Mitch and I own Cadia Capital. We don't own 2,000 units. That's mostly Mitch's fault.
Mitch.
We haven't had that much success.
What the hell?
But I know,
man. I just hold him back.
Yeah, no, but really, like, what's your criteria on something like that? What's the TOH, POH make? Like, tell us down to because I can tell you know exactly what you're looking for.
Yeah, we do. Okay, so typically let's talk about market metrics first. Typically, it's 50K population and above. We have to have a strong diversity in jobs, manufacturing jobs. They have to have been there for a long time and going to be there for a long time as well, too, because I'll get back to my strategy right after that. We look for an average home price for about 150K. That is a rule of thumb. And we look for a household medium income from 45 to 50K. That is, but anything lower than 45, we're probably not touching. And then proximity. I know a lot of people try to have within an hour of a metro. We like to be within 30 minutes of a metro. Or if it's its own standalone market, it has to hit all of our metrics and then some.
So 30 minutes within a metro that has at least 50,000 people.
Yeah, but it could be separate. Like our best performing asset is probably 2 hours outside of a metro, and it has 30K population, but it has incredible jobs. The household medium income is 55, and the household average price is like 190, right? And it's our best deal that we've ever had to date. And so that's our essentially market metrics that we look for. On our parks that we buy, we don't do a ton of value add. I think we all know here that infills are the hardest part of mobile home parks, especially bringing in new homes.
Oh, no, we buy everything based on a pro forma on infill. We're not supposed to be doing that.
Wait, hold on.
Shit.
Pasha, what's going on?
It's a 15 cap if you just bring in 50
no
homes.
problem. Just bring it in. The demand is there. They'll go ahead.
Right. You'll be fine.
Yeah.
We haven't infilled yet, but it's going great.
It's easy to find homes. Don't worry. That's no problem.
And so we look for at max about 10 to 15% of an infill play. And again, we're very conservative on those parks. We rarely even pro forma any new homes coming in the first year that we own it, and we start to underwrite for the year 2 for some of the homes coming in. We look for, when we first started, we were looking for mostly tenant-owned homes with about a 20% ratio maximum for POHs. We have now changed that to we are okay with buying POHs, yes, but only with a caveat that the homes have to be 2000s models and above. If it's lower, we don't want to touch it.
Is that because the value of those homes that you can convert them into tenant-owned homes, or what's your strategy with those park-owned homes?
Because it's easy, yes, because we have the RTOs and the sales of those homes. And if we do sell any of those homes, we don't even pro forma it into our numbers. So we don't rely on that, but we will RTO it, and we are building out our sales department just for strictly that. So
and for our listeners that don't know what POH, RTO means, so we had park owned homes. That's POH. The park, as the park owner, you own the homes. TOH, that's tenant owned homes, and then RTO, rent to own. So the tenant lives there; they're renting with a contract to purchase the property.
Yeah, the RTO too. Just for the listeners, the strategy there is to get the maintenance off your books, because and correct me if I'm wrong, Pasha, but like we like the RTO because you want to ride it so you get the maintenance off your books, because a lot of people don't understand how costly park-owned, community-owned homes will cost. 2,000 and above is a little better, but man, one HVAC can wipe out all the income for that park-owned home for a year. So you want to get the maintenance absolutely off the books as fast as you can.
Pasha, I have a question for you. Going back to the first time you raised capital, you said you were able to do that in the first 8 phone calls. Why do you think that was?
I will say it's because I've had over the last 10 years of my own real estate investing that I did, I've had so many people say, I want to be in on a deal if you ever raise capital. In the back of my mind, I always knew that I was going to build a business and I was going to raise capital at some point. But these are just like really close friends that have always mentioned, hey, whenever you're interested or whenever I can put money with you, let me know. So that's why it was pretty easy.
On that note, what are your, I had one more question, two questions. One was going back to what sort of utilities are you looking for in these parks? And the second one was, and what kind of debt are you getting? That's two questions. And then the third is, what sort of target returns are you offering your investors or projecting to your investors? So utilities was the first question. And what was my second question?
Financing.
Yeah, financing. Everything's on city utilities. We have personally one park that is our own that we bought a long time ago that is on septic, but we ran that through the ringer. We don't like septic. We try to shy away from it, but if they're all newer and everything passes really well, we'll buy it. Secondly, the financing that we typically put, we use 5-Star National Bank. So on the offset, we typically get about 55 to 60% LTV, but we also have an earnout component. An earnout component is where you have a predetermined refi after you hit a certain DSCR. So like, let's say by year 2, you then get that extra 10% or 15% LTV back.
Is that recourse, non-recourse, agency?
No, it's recourse. It's recourse. And we put it all, me and my partners sign off on the recourse debt.
You see his head drop right there. It's recourse.
Mitch.
Yeah, it sucks.
Mitch personally guaranteed.
Yeah, good job, Mitch.
And are you looking for like 50 pads and above, 100 pads? Like you have a minimum on the pad count?
We don't want to touch anything under 50 pads anymore.
Under 50.
Okay. Yeah. Yeah, it makes sense. And what are you offering your investors? Like, you don't have to answer this. We can edit it out.
No.
Like when you're going back to your investors, like some people are out there saying, we'll give you a 17% IRR, X% cash on cash, X, equity multiple. Like how does that structured with your investors?
So first thing is first, I have to mention that we have a super long-term strategy. We're forever holders, right? We want to take advantage of the tax code, real life monopoly, right? We want to let time do the work for us. So we project an 18% IRR on a hypothetical 10-year sale. But our biggest metric we look at when we underwrite is we have to return back all investor capital by year 5. And that's the number one metric. If we don't return 100% capital of that park, then we don't even touch it. And then now lately in the last fund, we changed it to that we want to hit at least 7% cash flow in year 2, because some of the properties you have to put a lot of CapEx, change it around, start stabilizing it. We do look for around a 10% cash on cash over a 5-year period.
Global or for your investors?
For the investors. And that's all net of fees and everything like that.
Are you guys doing like prefs? Are you guys taking, is it 70-30? Like what's the LP-GP split?
So what we do is a 7 pref, and then we do a 65-35, and we do a European model where the European model is that typically how most operators work, and I don't know how you guys structure yours, is that you get a pref and then the 65-35 gets split right after that pref, right? European waterfall is that we don't touch $1 until all investors are paid back 100% in full, and then we go to our splits in perpetuity.
For those listening, a European model isn't what you think, although some of us might want a European model. This is really an economic model for how you structure deals with your investors. Not as cool as an actual European model. But.
Yeah. And for anyone who's listening, the reason why we like the European model is that because we have to do good by our investors before we even start taking our percentages.
But you take an asset management fee, right? So you can keep the lights on and pay your overhead.
No
asset management fee. You take no money out, no cash flow out of these deals until your investors are fully paid back.
Well, we are the property managers, so we do take a 6 to 8%. I mean, our last fund was 6%, but this one was 8%. And we take an acquisition fee. Outside of that, we don't have any other fees whatsoever.